Ladies and gentlemen, in just hours, silver has plummeted from over $83 to $72, sending shockwaves through global markets and shaking investors to their core. This isn't just another correction. This is one of the most violent moves in precious metals history. And what happened in the last 72 hours will change the silver market forever. Stay with me, because what I'm about to reveal will blow your mind. Let me paint you a picture. December 30th, 2025. Silver hits an all-time record high of 86.62 per ounce. Traders are celebrating. Forums are buzzing. The silver squeeze is finally real. Then December 29th arrives, and everything collapses. Silver crashes 8.7% in a single day, the largest single-day drop since February 2021. Over $10 per ounce evaporated in hours. But here's what makes this absolutely extraordinary. Silver had just completed the most spectacular year in modern history, up 150% year-to-date in 2025. Let me repeat that. 150%. This wasn't some penny stock. This was silver, a global industrial metal worth trillions. Silver didn't just outperform gold, it crushed it. It demolished every prediction, every analyst forecast, every conservative estimate. This was silver's strongest year on record, surpassing even the legendary 1979 Hunt Brothers rally. The metal broke out of a 40-year consolidation pattern. 40 years. That's longer than most of you watching this video have been alive. Technical analysts were projecting targets between $250 and $300. Investment banks were scrambling to revise their forecasts. Retail investors were piling in. The momentum was unstoppable, or so everyone thought. Because on December 29th, reality hit like a freight train. The question everyone's asking is simple. Why did this happen? And the answer is far more complex and terrifying than you can imagine. But before we dive into the crash, you need to understand what happened on January 1st, 2026, today, right now. Because while you were celebrating New Year's, China just changed the entire game. At midnight, Beijing time, China implemented new silver export licensing restrictions. This isn't a rumor. This isn't speculation. This is happening right now, and the implications are absolutely massive. Here's what you need to know. China announced these restrictions on October 30th, 2025. They gave the world exactly 2 months' notice. 2 months to prepare for the biggest supply shock in silver market history. The new rules require all silver exporters to obtain licenses from the Ministry of Commerce. But here's the kicker. Only companies producing at least 80 tons of silver annually qualify for these licenses. 80 tons. That's a massive threshold that immediately excludes smaller players from the export market entirely. Think about what this means. China isn't banning silver exports outright. That would be too obvious, too aggressive. Instead, they're implementing a sophisticated control system that achieves the same result with plausible deniability. Only large, state-certified companies get access to state-controlled export licenses. The rest? Locked out completely. And here's the number that should terrify you. This licensing framework restricts 60 to 70% of the global silver supply to domestic use. 60 to 70%. China just removed the majority of tradable silver from international markets. But why is China doing this? The official reason is to secure domestic supply for China's rapidly growing industrial needs. Solar panels, electronics, electric vehicles. China is building the future, and silver is the metal that makes it all possible. Beijing watched as silver prices exploded in 2025 and realized something critical. If they don't control supply now, they'll be held hostage by market prices later. So they're locking down supply before the real shortage begins. This is the same playbook China used with rare earth elements. The same strategy they deployed with antimony. Identify a critical resource, dominate production, then restrict exports to secure domestic advantage. It's economic warfare disguised as industrial policy. And it's devastatingly effective. Even Elon Musk weighed in on December 26th, warning that this is not good and that silver is needed for many industrial processes. When the world's richest man is sounding alarm bells about a commodity, you should probably pay attention. Now, here's where things get really interesting. Silver prices surged 9% to hit a record high on Friday, December 26th, reaching $78.53 per troy ounce. The market was pricing in the supply shock. Then came the Shanghai premium. During Asian trading hours, silver in Shanghai was trading at an $8 per ounce premium over London prices. $8. That's the biggest spread on record, ever. This wasn't just demand, this was panic buying ahead of the export restrictions. Chinese buyers were scrambling to secure physical silver before the gates closed. Industrial users were stockpiling. Manufacturers were front-running the licensing system. The physical market was in absolute chaos, and that physical demand pushed prices to $86.62 on December 30th. But the paper market was about to have its revenge, because while China was restricting physical supply, The CME Group was dropping a bomb on leverage traders. On December 29th, 2025, the CME raised margin requirements on silver futures contracts. The initial margin for March 2026 contracts jumped to $25,000 per contract. But here's what most people don't understand. And this was the second margin hike in 1 week. The CME had already raised margins days earlier. Then they did it again. Back-to-back margin increases in the most volatile silver market in decades. Let me explain what margin requirements actually mean. When you trade futures contracts, you don't need to put up the full value of the contract. You only need to post a margin, essentially a deposit. When the CME raises margin requirements, traders must either deposit more cash or close their positions. And if they can't meet the new requirements, automatic liquidation. Their positions get closed whether they like it or not. This is where the crash begins. Thousands of small traders who had ridden the silver wave to $86 suddenly faced a choice. Put up more cash immediately or get liquidated. Most didn't have the capital. The holiday season had drained accounts. Liquidity was tight. Trading volumes were thin due to New Year's preparations. So they started selling. And in a thin market, selling begets more selling. The forced liquidations created a cascade effect. As prices dropped, more traders hit their liquidation thresholds. More automatic sell orders triggered. The price dropped further. More liquidations. More selling. It became a self-reinforcing doom loop that crushed the market in hours. Silver fell from over $83 to $72. Some intraday swings saw it touch even lower. The violence of the move was historic. But there's another layer to this story that almost nobody is talking about. President Trump's critical minerals executive order. And this is where things get really interesting. On March 20th, 2025, Trump signed an executive order titled Immediate Measures to Increase American Mineral Production. This order invoked emergency powers to boost domestic critical mineral production and reduce U.S. reliance on China. The timing is not coincidental. The order accelerated production of critical minerals in the United States to diversify supply chains. It gave agencies just 10 days to compile lists of pending mineral production projects that could be immediately approved. 15 days to nominate candidates for Fast 41 status, which fast-tracks approvals. The order invoked the Defense Production Act and delegated authority to the Secretary of Defense to direct industrial production. It authorized the CEO of the DFC to issue direct loans and loan guarantees for domestic mineral production. But here's the critical detail everyone missed. In November 2025, silver was added to the U.S. Geological Survey's critical minerals list. The list expanded from 50 to 60 items. Silver made the cut. And once silver became a critical mineral, it fell under the scope of Trump's executive order. This means silver production in America now receives fast-track permitting, Defense Production Act authority, and direct federal financing. The order also expanded the definition of critical minerals to include copper, uranium, gold, and potash. With silver now on the list, the Trump administration can legally prioritize domestic silver mining and processing. They can invoke national security powers to boost production. They can redirect federal resources to silver projects. And most importantly, they can begin strategic stockpiling. Because that's what this is really about. Strategic reserves. Think about it, logically. China is locking down 60 to 70% of global silver exports. America just designated silver as a critical mineral. Both superpowers recognize the same truth. Silver is essential for future technology. And whoever controls supply controls the future. Solar panels require silver. Electric vehicles require silver. Semiconductors require silver. 5G infrastructure requires silver. AI data centers require silver. Defense systems require silver. The entire fourth industrial revolution runs on silver. And here's the terrifying part. Global silver demand is about to explode. The solar industry alone is projected to consume record amounts of silver in 2026. Every solar panel requires approximately 20 grams of silver for electrical conductivity. As the world transitions to renewable energy, solar installations are skyrocketing. China is building solar capacity at an unprecedented pace. Europe is mandating renewable transitions. America is subsidizing solar through the Inflation Reduction Act, and every single panel needs silver. Electric vehicles are the next massive demand driver. Modern EVs use almost twice as much silver as traditional cars due to complex electrical systems, battery management, and charging infrastructure. As EV adoption accelerates, silver consumption from automotive alone could increase by hundreds of millions of ounces annually. Then there's artificial intelligence. AI data centers require massive amounts of electrical infrastructure. Every server, every connection, every circuit uses silver for optimal conductivity. As AI expands, so does silver demand. The electronics sector continues growing exponentially. Smartphones, computers, tablets, smart home devices, wearables, every piece of modern technology contains silver. 5G networks require extensive silver use in antennas, circuit boards, and transmission equipment. Defense contractors need silver for weapon systems, communications equipment, and electronic warfare capabilities. Medical devices increasingly rely on silver's antimicrobial properties and electrical conductivity. The demand vectors are multiplying faster than supply can respond. And that's the crisis. Supply cannot keep pace with demand. Silver mining is not easily scalable. Most silver comes as a byproduct of copper, lead, and zinc mining. Only about 30% of silver comes from primary silver mines. You can't just flip a switch and produce more silver. It takes years to bring new mines online. Permitting, exploration, development, construction, these processes take a decade or more under normal circumstances. Even with Trump's fast-track permitting, new American silver production is years away from meaningful output. China knows this. That's why they're implementing export restrictions now, before the shortage becomes critical. They're securing supply while it's still available. And America is scrambling to respond with strategic stockpiling and domestic production incentives. But it might be too late. So what does all this mean for silver prices in 2026? Let's analyze the short-term and long-term implications. Short-term, we're looking at continued volatility. The crash from $83 to $72 was brutal, but it doesn't change the fundamental supply-demand equation. In fact, it might have made things worse. Leveraged speculators got flushed out by margin hikes and forced liquidations. Weak hands sold in panic. But the physical market fundamentals are stronger than ever. China's export restrictions took effect today, January 1st, 2026. The full impact won't be felt for weeks as existing contracts fulfill and stockpiles deplete. But when the physical shortage becomes apparent, prices will respond. Industrial buyers who need silver for production can't wait for prices to come down. They have to buy at any price. That's called inelastic demand. And it's a powerful force in commodity markets. The psychological level of $100 per ounce is now firmly in sight. Before the crash, analysts were projecting silver could test $100 in early 2026. The recent pullback might delay that timeline, but the fundamental drivers remain intact. Some technical analysts are pointing to long-term targets between $250 and $300 based on the 40-year breakout pattern. Those targets seemed crazy in 2024. They seem plausible in late 2025. After this crash, they seem inevitable again. Here's why. Silver broke out of a massive multi-decade consolidation. Technical patterns of this magnitude, once broken, tend to lead to explosive moves. The 1979 silver rally saw prices go from $6 to $50 in months. That's a 733% increase. Silver just went up 150% in 2025. If historical patterns repeat, and they often do in commodities, we're still in the early stages of this bull market. Goldman Sachs has warned that silver lacks the institutional and economic profile that supports gold, making it more vulnerable to sudden corrections. That's exactly what we just witnessed. But that same volatility works both ways. Silver crashes harder than gold, but it also rallies harder than gold. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, recently hit extreme levels. When this ratio normalizes, silver tends to outperform dramatically. Investment demand is also shifting. Retail investors got shaken out by the December crash, but institutional money is just starting to pay attention. When large funds and sovereign wealth allocations begin moving into silver, the relatively small market size means prices can move explosively. The entire silver market is tiny compared to gold, oil, or equities. A few $1 billion of institutional money could send prices soaring. Then there's the inflation hedge narrative. If inflation remains persistent through 2026, precious metals become increasingly attractive. Central banks have been buying gold at record rates. If that buying extends to silver, even modestly, it could overwhelm available supply. Remember, 60 to 70% of global supply is now restricted by China. The remaining 30 to 40% has to serve the entire rest of the world. That's not enough. Mining companies are responding to higher prices by ramping production, but it takes time. Exploration budgets are increasing. New projects are being greenlit. But the lag time between decision and production is measured in years, not months. Meanwhile, demand continues accelerating. This supply-demand imbalance is the core thesis for higher silver prices, and nothing that happened in late December changes that thesis. The crash was a liquidity event, not a fundamental repricing. The CME margin hikes and forced liquidations were technical factors that amplified a year-end profit-taking correction. But the underlying story, China's export restrictions, Trump's critical minerals policy, surging industrial demand, these factors are structural and long-lasting. They don't disappear because of a 15% price correction. In fact, the crash might have set up an even more explosive move higher. Weak hands are out. Over-leveraged traders are gone. The market is cleaned out and ready for the next leg up. And with China's restrictions now active, with Trump's policies accelerating domestic production, with industrial demand hitting new records, the stage is set for something extraordinary. So here's what you need to watch in the coming weeks and months. First, Monitor Shanghai silver premiums over London and New York prices. If those premiums widen dramatically, it signals that physical shortages are intensifying in Asia. Second, track industrial user behavior. If manufacturers start panic buying or announcing production delays due to silver shortages, that's a massive red flag. Third, watch for any additional Trump administration actions on silver stockpiling or mining incentives. Any announcement of strategic reserve purchases would be explosively bullish. Fourth, pay attention to solar panel production data. If solar manufacturers start reporting input cost pressures or supply constraints related to silver, prices will react. Fifth, monitor investment flows into silver ETFs and futures markets. When institutional money starts returning, you'll see it in the data. Sixth, track mining company announcements about new projects, production increases, or merger and acquisition activity. Consolidation in the silver mining sector often precedes major price moves. And finally, watch geopolitical developments between the US and China. If tensions escalate, if trade restrictions expand, if the economic Cold War intensifies, silver becomes an increasingly strategic asset. Both nations will prioritize securing supply. Both will restrict exports to protect domestic interests, and the rest of the world will be caught in a squeeze unlike anything we've seen in modern commodity markets. The crash from $83 to $72 was violent, shocking, and brutal for anyone caught on the wrong side. But in the grand scheme of what's unfolding in the silver market, this might be remembered as nothing more than a speed bump, a temporary correction in a much larger secular bull market driven by forces far more powerful than margin requirements or year-end profit-taking. China just locked down the majority of global silver supply. America just designated silver as a critical mineral under emergency executive powers. Industrial demand is exploding across solar, EVs, AI, electronics, and defense. Supply cannot keep pace. Mines take years to develop. The shortage is coming. And when it arrives, when industrial users are bidding against nations for scarce supply, when manufacturers are shutting down production lines because they can't source enough silver, when investors finally wake up to the magnitude of this crisis, the price moves we've seen so far will look quaint. $86 might not have been the top. It might have been just the beginning. $100 might not be the target. It might be a stepping stone. $250 to $300 might not be fantasy. It might be inevitability. Because what's happening right now in the silver market isn't just another commodity cycle. It's a once-in-a-generation supply shock meeting unprecedented demand growth in a geopolitically fragmented world where the two largest economies are competing for strategic resources. The crash of December 29th will be studied in trading courses for years as a perfect example of leverage, liquidity, and forced liquidation. But the silver story of 2026 is just beginning, and what happens next could make that crash look like a footnote in a much larger, much more explosive chapter in the history of this remarkable metal. So keep your eyes open, stay informed, watch the data, because the silver market is about to get very, very interesting. And those who understand what's really happening, those who can see past the short-term volatility to the structural transformation underway, they're going to be positioned for something extraordinary. The question is, will you be ready when it happens? Subscribe for market insights.